Hi there, everybody. Mike Petras here with MPRE Boise, and today we are diving into the latest Federal Reserve meeting that took place on January 29th, 2025, and what it means for the Boise housing market. So, what did the Fed have to say, and how does it impact you, whether you're a buyer, seller, or investor? Let's break it all down. But before we do, if you are looking for homes in more real time than websites like Realtor.com, Zillow, and Trulia, please visit www.mpre.homes and type in your search criteria today. Also, if you are looking to sell and want an idea of what your home may be worth in today's market, please also visit the same website, look in the upper right-hand corner, click on Home Evaluation, and type in your address. Now, of course, you will hear from me, but I do pride myself on being a non-pressure real estate agent. If at anything, I just simply like to give you a call and see how it is I can be of service when you're ready. So first off, Powell made it clear that inflation is showing signs of progress, but we're not quite at the 2% target yet. Go figure. Inflation is down to 2.6%, which is good news, but there's still work to do. The Federal Reserve is focused on keeping inflation on track, and right now we're dealing with mortgage interest rates in the 7s, and the federal funds rate is sitting at about 4.3%. But here's the important thing to note. While the federal funds rate impacts borrowing costs for banks, it does not directly control mortgage interest rates. It has a ripple effect throughout the financial markets, and here's why that matters for the housing markets. When the Federal Reserve raises or lowers the federal funds rate, it affects the cost of borrowing for banks, but it also ripples through other parts of the economy. Mortgage rates, which directly affect homebuyers, are influenced by the 10-year U.S. Treasury yield and mortgage-backed securities. When the federal funds rate goes up, it increased the cost of borrowing for banks, and they pass on that cost to consumer through higher mortgage interest rates. But the most important thing to remember is that mortgage interest rates do not follow the federal funds rate exactly. They're more closely tied to the 10-year Treasury note and MBS. The 10-year Treasury yield is considered a risk-free investment. It serves as a benchmark for long-term investments, and when the Federal Reserve lowers the federal funds rate, bond yields typically fall. This pushes investors towards higher yielding investments like MBS, which are tied to mortgage interest rates. When the Fed cuts the federal funds rate, it usually causes the 10-year Treasury yield to drop. And as the yield on the 10-year Treasury goes down, MBS becomes more attractive to investors, which in turn causes mortgage interest rates to drop. So, for home buyers, when mortgage interest rates drop, it means you can afford more home for the same monthly payment. But keep in mind, there is usually a lag, and market sentiment also plays a role. While rates may not immediately drop after the Fed cuts rates, we typically see mortgage interest rates start to follow that downward trend over time. Now let's talk about Boise. The median home sold price in Ada County is around $529,990, and in Canyon County, it's around $409,000. Right now, with mortgage rates in the 7, affordability is being squeezed. But if mortgage rates drop slightly, it could ease the pressure and make housing more accessible to potential buyers in Boise. Looking at other cities, Boise housing market still remains relatively affordable. In Austin, Texas, the median home sold price is around $490,000, and in Nashville, Tennessee, it's about $420,000. So even with higher mortgage interest rates, Boise market is still more affordable compared to some other popular cities in the U.S. Now, during this meeting, Powell also addressed the potential impact of tariffs. He mentioned that while higher tariffs could increase the cost of goods, there is a silver lining. If tariffs are offset by income tax cuts, it could benefit both businesses and individuals. If taxes are lowered to offset costs of tariffs, consumers would have more money in their pockets to spend. That could keep demand for homes strong, even if higher interest rates and tariffs are putting pressure on prices. This could be a potential boost for the housing market, especially in cities like Boise. Powell also mentioned that housing activity has stabilized. Higher mortgage rates have slowed the market a bit, but strong labor demand and a solid labor market are also helping to keep things steady. Essentially, the Fed sees housing as stable right now, no big fluctuations in prices, but no drastic declines either. So, while the Fed sees housing as steady, this could shift if inflation continues to cool or if mortgage rates drop. If rates decrease even slightly, we could see more buyers entering the market, which could keep prices stable or even potentially drive them up, especially given Boise's affordability compared to some other cities. So whether you are looking to buy or sell in 2025, the key takeaway is to keep an eye on these factors. The Federal Reserve's actions are shaping the future of the housing market. And as mortgage rates adjust, it could open new opportunities in Boise. Ultimately, though, decisions made by the Federal Reserve will have a big ripple effect on the housing market, with the federal funds rate influencing mortgage rates, 10-year Treasury yields, and MBS. So the Boise housing market could see improved conditions for homebuyers if the rates come down. Well, thanks again for watching, and be sure, if you like this information, to give me a like. Feel free to comment if you totally disagree with me, and subscribe to this channel for more insights into the Boise housing market. If you have any questions or are looking to buy, sell, or invest right here in the Boise housing markets, please feel free to reach out to me. Also, if you just need advice. So I look forward to that day that we speak. God bless, and I look forward to the day that I call you my neighbor.